Real estate investing can build long-term wealth, generate passive income, and create financial freedom. But it can also be extremely expensive when mistakes are made. In this video, we will break down the most common real estate investing mistakes that cost investors thousands, sometimes even hundreds of thousands, of dollars. Let's begin. Mistake number 1. Overpaying for the property. Many investors fall in love with a deal instead of analyzing the numbers. They assume appreciation will bail them out in the future. But real estate is won at the purchase price. If you buy too high, your cash flow shrinks, your margin disappears, and your risk increases. Always run the numbers conservatively. Compare similar sales. Stress test your assumptions. A small mistake at purchase can cost tens of thousands over time. Mistake number 2. Underestimating renovation costs. Renovations almost always cost more than expected. Materials increase in price. Contractors find hidden damage. Timelines stretch. Holding costs grow. If you budget $40,000, expect it to become $50,000 or more. Smart investors add contingency reserves of at least 10 to 20%. Without that cushion, profits disappear quickly. Mistake number 3. Ignoring cash flow. Some investors chase appreciation only. They buy properties that barely break even or even lose money each month. When interest rates rise or vacancies increase, they feel immediate pressure. Positive cash flow protects you during downturns. It gives flexibility and stability. Appreciation is a bonus. Cash flow is survival. Mistake number 4. Poor tenant screening. One bad tenant can cost thousands in missed rent, legal fees, and property damage. Rushing the screening process to fill a vacancy quickly is a costly error. Verify income, check credit, call references, review rental history. Prevention is far cheaper than eviction. Mistake number 5. Overleveraging. Using debt strategically can increase returns, but too much leverage magnifies risk. If rents decline or interest rates increase, highly leveraged investors struggle to refinance or hold their properties. Always plan for worst-case scenarios. Ask yourself, can I survive 6 months of vacancy? Can I handle rate increases? Mistake number 6. Skipping due diligence. Never rely solely on seller information. Inspect the property thoroughly. Review zoning regulations. Analyze local market trends. Study comparable rents. Unexpected foundation issues, roof replacements, or zoning restrictions can destroy projected returns. Mistake number 7. Underestimating operating expenses. Taxes rise, insurance premiums increase, maintenance is constant. Many new investors only calculate mortgage payments and forget about real operating costs. A realistic expense estimate protects your investment from negative surprises. Mistake number 8. Emotional decision-making. Fear and greed drive bad investment choices. Buying during hype cycles or panic selling during downturns can lock in losses. Real estate rewards disciplined, long-term thinking. Base decisions on data, not emotions. Mistake number 9. Choosing the wrong location. Location impacts appreciation, tenant quality, vacancy rates, and resale value. Buying in declining areas because properties seem cheap often leads to higher maintenance, weaker tenants, and slower growth. Research employment trends, infrastructure development, population growth, and neighborhood safety before buying. Mistake number 10. No exit strategy. Every investment should have multiple exit options. Can you refinance? Sell? Convert to short-term rental? Hold long-term? Markets change. Flexibility reduces risk. In conclusion, real estate investing is not just about buying property. It is about managing risk, controlling costs, and making disciplined financial decisions. The biggest losses rarely come from one dramatic mistake. They come from small miscalculations that compound over time. If you avoid these common mistakes, you dramatically increase your chances of building wealth instead of losing thousands.